Listen, something extraordinary is happening right now in the precious metals market, and if you own even a single ounce of gold or silver, what I'm about to share could fundamentally change how you think about your financial future. We're not talking about normal market movements here. We're talking about a convergence of forces that hasn't occurred in over 50 years, and the implications are staggering. Let me start with something that should terrify every central banker on the planet. In the last 18 months, central banks have purchased over 2,300 metric tons of gold. That's not a typo. 2,300 metric tons. To put that in perspective, that's more gold than exists in the entire Swiss National Bank's reserves. And here's what makes this absolutely critical. They're not slowing down. In fact, they're accelerating. The People's Bank of China just reported their 17th consecutive month of gold purchases, 17 months in a row. But here's where it gets interesting. Independent analysts believe China's actual gold reserves are somewhere between 3 and 4 times higher than what they're officially reporting. Why would they hide it? Because the moment the world realizes how much gold China actually controls, the entire dynamic of global currency markets shifts overnight. Turkey's central bank added another 42 tons last quarter. Poland is buying. India is buying. Even countries you wouldn't expect, like Singapore and the Philippines, are dramatically increasing their gold reserves. These aren't random decisions made by bureaucrats who don't understand markets. These are calculated, strategic moves by some of the smartest financial minds in the world, and they all see something coming that most retail investors are completely blind to. Now, let's talk about what's happening in the silver market, because this is where things get truly explosive. Silver is trading at roughly $85 per ounce as I record this, but the gold-to-silver ratio is telling us a story that most people aren't paying attention to. Historically, that ratio sits around 60 to 1. Right now, we're seeing distortions in that ratio that suggest silver is either dramatically undervalued or gold is preparing for a move that will make current prices look like a distant memory. But here's what really matters. Silver isn't just a monetary metal anymore. It's become absolutely critical to the technology that's defining our future. Every solar panel requires about 20 grams of silver. Every electric vehicle uses between 25 and 50 grams. 5G infrastructure, medical devices, water purification systems, they all require silver. And here's the kicker. Unlike gold, which gets recycled and stays in the monetary system, silver gets consumed. It's used in industrial applications where recovery is either impossible or economically unfeasible. The Silver Institute just released data showing that industrial demand for silver hit a record high last year, and it's projected to increase by another 14% this year. Meanwhile, global silver mine production has been essentially flat for the last 8 years. You don't need a PhD in economics to understand what happens when demand surges and supply remains stagnant, but it gets worse. There's a supply crisis brewing that almost nobody is talking about. The majority of silver production doesn't come from primary silver mines. It comes as a byproduct of copper, lead, and zinc mining. When those base metal prices drop, or when those mines become unprofitable, silver production drops with them. We saw this happen in 2015 and 2016, and we're seeing early warning signs of it happening again. Let me tell you about something that happened in 1980 that most people have forgotten. The Hunt brothers tried to corner the silver market. They accumulated over 100 million ounces of physical silver, and the price went from $6 an ounce to over $50 in a matter of months. The COMEX changed the rules mid-game, implemented position limits, and the Hunt brothers were eventually forced to liquidate. Silver crashed. But here's what's different now. The Hunt brothers were two individuals trying to manipulate a market. What we're seeing today is organic demand from industries that have no choice but to buy silver, combined with investment demand from people who are watching their currency lose purchasing power in real time. You can't change the rules to stop technological demand. You can't implement position limits on solar panel manufacturers or electric vehicle producers. This isn't manipulation. This is fundamental supply and demand economics playing out on a global scale. Now let's connect some dots that the mainstream financial media refuses to acknowledge. In 2020, the Federal Reserve expanded its balance sheet by over $3 trillion in a matter of months. The European Central Bank, the Bank of Japan, the Bank of England, they all did the same thing. That money didn't disappear. It's still in the system, and it's still looking for a home. When you create trillions of dollars out of thin air, you don't get to choose where that inflation shows up. Sometimes it's real estate. Sometimes it's stocks. Sometimes it's commodities. But eventually, it shows up in hard assets, and gold and silver are the ultimate hard assets. They can't be printed. They can't be created by a central bank with a keystroke. They exist in finite quantities, and that scarcity is becoming more valuable every single day. Here's something that should make you sit up and pay attention. The COMEX, which is the primary exchange for precious metals futures in the United States, has been experiencing something unprecedented. The ratio of paper claims to physical metal has been expanding dramatically. There are estimates suggesting that for every ounce of physical gold in COMEX vaults, there are over 100 paper claims against it. Think about what that means. If even a small percentage of those paper holders decide they want physical delivery, the entire system could seize up overnight. We saw a preview of this in March 2020. The spread between paper gold prices and physical gold prices exploded. Dealers were charging premiums of 15, 20, even 30% over spot price if you could find physical metal at all. Mints around the world ran out of inventory. The U.S. Mint suspended production of certain coins, and that was just a temporary liquidity crisis. Imagine what happens during a real crisis of confidence in the monetary system. Let me paint you a picture of what's happening right now in the physical market. Bullion dealers are reporting wait times of 4 to 6 weeks for certain products. That's not normal. In a functioning market with adequate supply, you should be able to get physical metal within days. The fact that premiums are elevated and wait times are extended tells you that there's a disconnect between the paper price you see on your screen and the actual physical market where real metal changes hands. And here's where it gets personal for anyone holding retirement accounts. The traditional 60-40 portfolio, 60% stocks, 40% bonds, that model is broken. Bonds are yielding negative real returns after inflation. Stocks are trading at valuations that historically precede major corrections. Real estate is priced at levels that are unsustainable for most buyers. Where exactly are you supposed to preserve wealth in this environment? Quick aside here, and this is important. If you're sitting on $100,000 or more in retirement accounts, I put together a comprehensive guide on how gold IRAs actually work. It's linked in the description below. It covers the mechanics of getting physical gold into your retirement account without triggering tax penalties, the custodian requirements, the storage regulations, all of it. If you're thinking about diversifying your retirement holdings into precious metals, it's worth checking out. No pressure, but the information is there if you want it. Anyway, back to what's happening in the macro environment, because this is where things get really interesting. The BRICS nations, Brazil, Russia, India, China, and South Africa, have been openly discussing the creation of a gold-backed currency for international trade. Now, whether that actually happens or not is almost irrelevant. The fact that they're discussing it publicly tells you everything you need to know about the direction of the global monetary system. For the last 50 years, since Nixon closed the gold window in 1971, the world has operated on a pure fiat currency system. The dollar has been the global reserve currency, backed by nothing except the full faith and credit of the United States government. That system has allowed the U.S. to run massive deficits, to print unlimited amounts of currency, and to export inflation to the rest of the world. But that arrangement only works as long as everyone agrees to play along. The moment countries start settling trade in currencies other than the dollar, or worse, in gold-backed instruments, the entire dynamic changes. The demand for dollars decreases, the ability of the Federal Reserve to print without consequences diminishes, and the value of hard assets like gold and silver relative to fiat currency increases exponentially. Let me tell you about something that happened in 2011 that most people have forgotten. Gold hit an all-time high of $1,900 per ounce. Silver briefly touched $50, and then both metals entered a brutal bear market that lasted for years. People who bought at the top watched their investments lose 30, 40, even 50% of their value. The mainstream media declared that gold was dead, that it was a barbarous relic, that anyone holding precious metals was a fool. But here's what actually happened during that bear market. Central banks kept buying, China kept accumulating, India kept importing. The smart money didn't panic. They understood that the fundamentals hadn't changed. The currency debasement was still happening. The debt was still growing. The structural problems in the global financial system were still there, just temporarily papered over by more money printing and more debt. And then, slowly at first, then all at once, gold started climbing again. It broke through the 2011 high. It kept going. And now we're in territory that would have seemed impossible just a few years ago. But here's the critical point. This isn't a speculative bubble driven by retail investors chasing momentum. This is a fundamental repricing of monetary metals in response to the largest currency debasement experiment in human history. Let's talk about what's happening in the mining sector, because this is where the supply side of the equation gets really concerning. Gold mining is an incredibly capital-intensive business. It takes 7 to 10 years to bring a new mine from discovery to production. It costs hundreds of millions, sometimes billions of dollars, and the ore grades have been declining for decades. In the 1970s, the average gold mine processed ore with grades of around 10 grams per ton. Today, many mines are processing ore with grades of 2 or 3 grams per ton. That means they have to move exponentially more rock to produce the same amount of gold. The energy costs are higher, the environmental impact is greater, the economics are more challenging. And yet, the price of gold hasn't increased proportionally to reflect these realities. What that tells you is that gold is still undervalued relative to the cost of production. When you factor in the true all-in sustaining costs of mining, including exploration, development, and reclamation, many gold miners are barely profitable at current prices. And if they're barely profitable, they're not investing in new projects, which means future supply is going to be constrained even as demand continues to increase. The silver mining situation is even more precarious. There are very few primary silver mines left in the world. Most silver production comes from polymetallic deposits, where silver is a byproduct. When copper prices drop, when lead and zinc become unprofitable, silver production drops with them, regardless of what the silver price is doing. That creates a supply dynamic that's completely disconnected from the demand side of the equation. Now let's talk about what's happening in the derivatives market, because this is where the real risk lies. The notional value of gold and silver derivatives dwarfs the actual physical market by orders of magnitude. Banks and financial institutions use these derivatives to hedge risk, to speculate, and yes, to manage prices. But derivatives are only as good as the counterparties behind them. In 2008, we learned what happens when counterparty risk becomes systemic. Lehman Brothers collapsed. AIG had to be bailed out. The entire financial system came within hours of complete seizure. And the derivatives market for precious metals is exponentially larger and more complex now than it was then. If there's another crisis, if counterparties start failing, if margin calls can't be met, the paper market for gold and silver could implode, and the only thing left standing will be physical metal. Here's a question you need to ask yourself. If the financial system experiences another crisis, if banks start failing, if currency controls are implemented, if there's a bail-in where depositors take losses to recapitalize banks, what assets do you want to own? Do you want to own paper promises from institutions that might not exist in 6 months? Or do you want to own physical assets that have maintained value for thousands of years? Let me tell you about something that's happening right now in the ETF market that should concern anyone who thinks they own gold through a fund. The largest gold ETF in the world, GLD, holds physical gold in vaults. But if you read the prospectus carefully, you'll discover that you don't actually own that gold. You own shares in a trust that owns gold. And in a crisis, there's no guarantee you'll be able to redeem those shares for physical metal. During the March 2020 crisis, the premium on physical gold exploded while the ETF price stayed relatively close to spot. Why? Because the ETF is a paper instrument that trades based on supply and demand for shares, not based on the actual physical market. If you owned GLD during that period and tried to redeem for physical, you would have been out of luck. The ETF is designed for institutional investors and authorized participants, not for retail holders who want to take delivery. The same dynamic exists in silver ETFs. You're holding a paper claim on metal that you can't access in a crisis. And in a real crisis, when you need that metal most, that's when the disconnect between paper and physical becomes catastrophic. This isn't fear-mongering. This is understanding the structure of these instruments and the risks they carry. Now let's talk about what's happening with inflation, because this is the elephant in the room that everyone is dancing around. The official CPI numbers say inflation is running at 3 or 4%, but anyone who buys groceries, pays rent, fills up their gas tank, or sends kids to college knows that's complete nonsense. Real inflation, the inflation you experience in your daily life, is running at 8, 10, maybe 12% or higher. When inflation is running that hot, holding cash is a guaranteed way to lose purchasing power. Every year, your dollars buy less. Every year, your savings are worth less. And the Federal Reserve has made it clear that they're willing to tolerate higher inflation to avoid a recession. That's a fancy way of saying they're going to keep printing money and hope the problem solves itself. But here's what history teaches us. Inflation doesn't solve itself. It accelerates until something breaks. In the 1970s, it took Paul Volcker raising interest rates to 20% to break the back of inflation. 20%. Can you imagine what would happen to the economy, to the stock market, to the real estate market, if the Fed raised rates to 20% today? The entire system would collapse. So they won't do it. They can't do it, which means inflation is going to continue and the purchasing power of fiat currency is going to continue to decline. And in that environment, Hard assets like gold and silver aren't just a good investment. They're a necessity for anyone who wants to preserve wealth across time. Let me share something with you that most people don't understand about gold. Gold doesn't go up in value. Gold maintains its value while currencies lose purchasing power. An ounce of gold today buys roughly the same amount of goods and services that an ounce of gold bought 100 years ago. It's not that gold is appreciating, it's that the dollar is depreciating. When you see gold at $3,000 per ounce, that's not gold becoming more valuable. That's the dollar becoming less valuable. And when you understand that distinction, you realize that holding gold isn't about making money. It's about not losing money. It's about preserving purchasing power in an environment where every fiat currency in the world is being systematically debased. Silver has the same monetary properties as gold, but with the added benefit of industrial demand. That dual nature makes silver incredibly volatile, but it also gives it explosive upside potential. When silver moves, it moves fast and hard. We saw it in 2011. We saw it in 2020. And we're likely to see it again as this cycle plays out. Here's what's coming, and you need to understand this clearly. We're in the late stages of a debt supercycle that's been building for decades. Global debt is over $300 trillion. That's not sustainable. It can't be paid back through economic growth. It can only be inflated away through currency debasement. And that process is already underway. Central banks are trapped. If they raise rates to fight inflation, they crash the economy and trigger a debt crisis. If they keep rates low and keep printing, they fuel more inflation and destroy the currency. There's no good option. There's no painless way out. And in that environment, the only rational response is to own assets that can't be printed, that can't be debased, that maintain value regardless of what central banks do. Gold and silver are those assets. They've been money for 5,000 years. They've survived the collapse of every empire, every currency, every financial system that's ever existed. And they'll survive whatever comes next. If you own gold or silver right now, you're positioned for what's coming. If you don't, you need to seriously consider whether your current portfolio can withstand the monetary chaos that's unfolding. This isn't about getting rich quick. This is about protecting what you've already built. This is about ensuring that your wealth survives the transition from one monetary system to the next. The future is being defined right now, in real time, by decisions being made in central banks, in government offices, in trading rooms around the world. And the people who understand what's happening, who position themselves accordingly, are going to be the ones who come out the other side with their wealth intact. The question is, are you going to be one of them? You going?